What if I told you that missing just a few days in the stock market could cost you thousands of dollars over time? Or that many people who try to buy low and sell high actually end up doing the opposite? Today, we're breaking down one of the biggest debates in investing: time in the market versus timing the market, and which one really helps beginners build wealth. If you're new to investing, you've probably wondered, should I wait for the market to crash? Is now a bad time to invest? What if I invest and everything drops tomorrow? Totally normal questions. In this video, we'll define time in the market and timing the market. Explain why timing is so tempting and so hard. Show what history teaches us. Share beginner-friendly tips to invest smarter and with less stress. Let's start with the basics. What is timing the market? Timing the market means trying to predict the perfect moment to buy or sell. Example: waiting for prices to drop before investing. Selling because you think a crash is coming. Jumping in and out of investments based on news or emotions. The idea sounds great. Buy low, sell high. But here's the problem. You have to be right twice, when you buy and when you sell. And even professional investors with teams, data, and experience often get it wrong. Why timing the market is so hard. The market moves based on economic data, company earnings, interest rates, global events, and human emotions like fear and greed. By the time good or bad news reaches you, prices have usually already changed. Many people sell when prices drop because they're scared. Buy when prices rise because they're excited. That's the opposite of what timing the market requires. And missing just a handful of the market's best days can dramatically reduce long-term returns. What is time in the market? Time in the market means investing consistently, staying invested through ups and downs, letting compounding do the heavy lifting over years. Instead of asking, is now the perfect time to invest? You ask, can I stay invested long enough for growth to happen? This approach focuses on patience, not prediction. Why time in the market usually wins. Historically, markets trend upward over long periods, even though they're volatile in the short term. When you stay invested, you benefit from long-term growth. You avoid emotional decisions. You capture more of the market's strongest days. Compounding works best with time, not perfection. Think of investing like planting a tree. You don't dig it up every week to check progress. You give it time, water it regularly, and let it grow. A simple example. Imagine two investors. Investor A waits for the perfect time to invest. They sit in cash for years, scared of crashes. Investor B invests small amounts regularly and stays invested, even during downturns. Over time, Investor B often ends up with more, not because they're smarter, but because they stayed consistent. The market rewards discipline, not guesswork. Beginner-friendly investing tips. Here are practical tips if you're just starting out. 1. Invest regularly. Instead of investing all at once, spread it out over time. This reduces stress and risk. 2. Think long-term. Money you invest should be money you don't need soon. Long-term thinking makes short-term drops less scary. 3. Ignore daily noise. Headlines are designed to grab attention, not help your portfolio. 4. Diversify. Don't rely on one investment. Spreading your money helps manage risk. 5. Emotions are the enemy. Fear and excitement can push you into bad decisions. A simple plan helps you stay calm. When timing can make sense. Timing isn't always bad, but it's limited. Examples: rebalancing your investments over time, adjusting risk as your goals change. Notice the difference. This isn't guessing market crashes, it's managing risk thoughtfully. Final takeaway. Here's the truth. You don't need to predict the market to be a successful investor. For most beginners, time in the market beats timing the market, again and again. Start small, stay consistent, be patient. Because in investing, time is often your greatest advantage.